Welcome, everybody. April 11th, the Market Update Desk with Scott Riley, powered by Mortgage One. Well, we sort of made it through yesterday's CPI data. It was a brutal day yesterday between that bond auction, a couple other things. Wanted to go over transitioning into today, some of the information today, and what we're seeing going forward. Uh, Earlier today, we had the European Central Bank had their meeting, and they decided to hold their rates steady, but they seem to want to start cutting rates probably even as early as June because of the slowing pace of inflation and the weakness of their economy. Now, the European economy is structurally very different where it is right now compared to the US with GDP growth, all those different things. So they're in a little bit of a different spot, but it's nice to see some of the central banks talking about rate cuts. Um, Yesterday afternoon continued the bad day after the CPI numbers. The 10-year bond auction was really met with lackluster enthusiasm, graded about a D minus. So that kept the day in just swimming in the red. We actually had a price adjustment for the worse late in the day. Uh, the big one today was the producer price index, and that showed that it rose. The headline rose 0.2 in March, and that's 1/10 better than expected. It's very nice to say better than expected versus the CPI data and previous to that the PCE data that we got that just didn't cooperate. Year over year, PPI did increase from 1.6 to 2.1%, but it was less than expected of what the market was thinking of 2.2%. Food prices jumped 0.8% month over month. Now that's after February's rise of over 1.1%. We're all seeing it in the grocery stores. The food prices are just being pressured. In fact, chicken prices in particular, this is an amazing stat, went up just over 10%. And fresh and dry vegetables also went up. So these food prices are continuing to put strain on household budgets. The core rate rose 0.2%, and that was in line with estimates. Year over year rose from 2% to 2.4%. Sounds bad, but that's actually right in line approximately with what the market was expecting at 2.3%. Actually, the 2.49 non-rounded was a little bit closer to 2.37, so we weren't that far off. Overall, the readings were much better than what was feared after that CPI report on Wednesday. Some of the PPI components actually going to give us some benefit as we go forward because those fall into the PCE report, which will come out on the 26th. With any luck, we'll get a little bit better than what the market anticipates right now when we get the PCE report on the 26th. That could maybe claw back some of these dramatic losses we've been seeing in the 10-year bond and mortgage-backed securities. The Fed minutes came out from their last meeting. While there wasn't a lot of new technical insights as far as the timing of rate cuts, we did get some very important data as it regards to their balance sheet and the runoff. This could be a very good thing for mortgage rates. The vast majority of Fed members said it was prudent to slow the pace of runoff fairly soon. Most supported halving the pace of runoff, cutting it in half. Currently, they're allowing just about $60 billion in treasuries and about $35 billion of mortgage-backed securities to fall off the balance sheet every month. Because of high interest rates, keeping mortgage bond runoff very subdued compared to traditionally, officials would need to leave that part of their program unchanged and instead of slow runoff by allowing fewer treasury securities to mature every month. If they were to cut this in half, it would mean that they would likely be purchasing, not running off, but purchasing in the neighborhood of $30 billion in bonds through reinvestment, which would certainly help the bond market because it would have less supply out in the marketplace. Now, possibly they could be starting or announcing this in the June meeting, that would be very, very good for the bond market. And man, the bond market needs some good news. Jobless claims, first time filers fell by 11,000, so to 211,000 total, not a huge change. Jobless claims did rise 28,000 to 1.817 million. That stayed pretty consistent over the last multiple reportings. Today, we are going to have a pretty important thing, a 30-year bond auction at 1 o'clock. We're hoping that doesn't follow the pattern of what the 10-year bond auction was yesterday. Currently, the 10-year bond is at 4.57. Once again, that's a high for 2024. And the resistance level, the topside resistance level that's next is 4.63. We're hoping we don't test that because there's even a lot of space above that. Mortgage-backed securities yesterday took it in the teeth, and we were down a little over 86 basis points yesterday. Today, we're down about 14 basis points. As we go forward, I think we're going to stay in this trading pattern, for the market technicals, probably through the end of this week. Next week, I suspect maybe we get some of it back starting Monday, Tuesday. We'll have multiple Fed speakers next week, and then the week after that's going to be the PCE report. Let's hope we kind of get on a path where we can claw back some of these losses, get on some even ground, and start to recoup what we have lost. We're here to give you information. The Market Update Desk is the #1 original news source for market information for West Michigan. We are here for you. Give us a call. We're happy to explain all this and help educate you, both our realtor partners and our clients. Let's work together to make it a great day. 616-293-2189. Take care.